Everyone, welcome to part 2 of my 3-part webinar series on cost accounting and best practices to minimize taxes. In part 1, I provided an overview with some key definitions. And now in part 2, we're going to walk through one example of a tax position that some cannabis companies may choose. This will not work for every business, and I'm not saying it's my favorite or the best. My goal is to demonstrate how good accounting can mitigate tax liability. So now let's get into it. Introducing cost accounting. The idea here is that we can include certain costs as inventory rather than a non-deductible expense. How? We allocate direct and indirect production costs to inventory as an asset. So basically, we're booking costs as an asset. Costs included in inventory are direct materials, direct labor, and overhead, aka indirect costs. So direct costs are straightforward. 100% of those can go to inventory because they are directly related to production. Indirect costs or overhead must be further categorized into 3 buckets. Those costs that you must allocate, costs that you never allocate, and costs that you allocate if you're using GAAP accounting. So if you recall from part 1, GAAP stands for Generally Accepted Accounting Principles. So it comes down to whether the cost is necessary for production. You have to ask yourself, is soil necessary for production? Yes. Is advertising necessary for production? No. It may be necessary for your business, but not a direct cost of production. So it is this third bucket of indirect costs where proper accounting really shines. Using GAAP allows businesses to allocate more types of costs to inventory, which will become COGS when sold and ultimately lower your taxable income. So public companies have to use GAAP. Private companies don't have to, but in this case, there certainly is a strong case and a lot of benefits to doing so. So now to get into the nitty-gritty of cost accounting, it starts with a strong foundation in the chart of accounts. Set it up one time with any subsequent changes going through a governance process. This is typically triggered by a new transaction, a new revenue stream, or a new expense that did not previously exist. There has to be some degree of approval that happens to make changes to the chart of accounts. Then you're going to identify line by line, direct and indirect expenses, and further determine an allocation rate for indirect expenses based on a driver. For example, building-related expenses may use square footage as a driver. Labor expenses may use time tracking. Direct expenses, on the other hand, are straightforward because they can be allocated entirely 100% to inventory. So you're going to review the chart of accounts at least annually and more often in the first year of business. Then the monthly accounting cycle functions on top. Beginning with bookkeeping, in this case, we're talking about calculating total costs to include in inventory, followed by an accurate inventory count to determine a ratio of quantities of work in process, finished goods, and inventory sold. And inventory here, we're talking quantities, not dollars. The allocation piece is driven by the inventory quantities and the cost allocation rates. So let's look at an example. So we're going to talk about, for example, rent expense. Rent is an indirect cost. Let's say that your rent is $1,000 a month, and you determine that 80% of the square footage of your space is dedicated to direct production, or $800, which is 80% of 1,000. Then you do your inventory count and you determine that 48% of your total inventory was sold. So that means 48% goes to cost of goods sold. So $800, the portion of your building that is dedicated to direct production, times that 48%, the inventory that was sold, means that $384 of rent expense is allocated to COGS. So that means that $384 will reduce your taxable income. Now, if this is done correctly, a manager will look at a P&L and they'll still see $1,000 rent expense as opposed to $200, which is that 20% that was not allocated. And without getting into the details of the journal entry, I will just point out that this is another example of how important a good chart of accounts is. And there you have it. I just covered a lot of detail in a short amount of time. So please reach out with any questions in a comment. And as always, spread some internet karma with a like, share, and subscribe. Thanks.